There is a number that the biggest banks in the world would prefer you never find out. It's not a secret number kept in a safe in Manhattan. It is not a formula protected by confidential clauses in Wall Street contracts. This number is open, public, visible to anyone who wants to look. The problem is that no one teaches you how to see it. And do you know what that number is? $20,000. $20,000 represents the exact point at which the average person starts to become dangerous to the traditional banking system. Not because she's going to sue them, not because she's going to do anything illegal, but because, from this specific value, she starts to have real options. And real options mean she can start saying no. And nothing, absolutely nothing, frightens a financial institution more than a customer who has learned to say no with mathematical knowledge behind the refusal. But before I explain to you why this number is so critical, I need to tell you a story that begins not on Wall Street, not in some century-old bank on Fifth Avenue, but in a mathematics department at a university in the state of New York in the late 70s, where a man with disheveled hair and a lifelong cigarette between his fingers was tired of trying to decipher the mysteries of cosmic space and decided to apply the same mathematical tools to decipher the mysteries of an even larger universe. Chaotic. The American financial market. James Simons was not a banker. It never was. He was a mathematician who had contributed to theories of differential geometry used in particle physics. He had worked for the NSA decrypting codes during the Cold War. He was the kind of person who saw patterns where others saw chaos, who saw structure where others saw randomness, who found equations where others found only luck and intuition. And when he first looked at financial markets with truly mathematical eyes, he was shocked. Not with the complexity he found, with the simplicity of the illusions that supported the entire system. He discovered that banks and traditional investment managers were building empires on a foundation of beliefs that didn't stand up to a single serious statistical test. And more than that, he discovered that the average investor, the person working 40 hours a week in Austin, Texas, or Cleveland, Ohio, or any mid-sized American city, was being systematically kept from knowledge that could completely transform their relationship with money. Not because this knowledge was too difficult to understand, but because if everyone understood, the big bank's business model would collapse immediately. What Simons discovered over 3 decades of operating his Renaissance Technologies Fund, generating average annual returns of 39% before fees for more than 30 consecutive years, a performance that, according to analyses published in the Journal of Finance and documented by the National Bureau of Economic Research, is statistically as unlikely as winning the state lottery 6 times in a row. What he discovered was not magic. It was logic. A logic that anyone with $20,000 in a bank account can start applying immediately. And it is exactly this logic that this script will reveal to you, piece by piece, layer by layer, until the complete mystery is exposed. But first, I need you to understand the central paradox that no bank wants you to notice. There is a scene that is repeated millions of times a day in bank branches across the United States. One person enters. He has some money saved. This may be the first time she has saved a significant amount of money. Maybe $5,000, maybe $15,000, maybe exactly $20,000. She is proud. He worked hard to get there. And she goes to the bank because she instinctively feels that the bank is the right place for that money to grow. The manager welcomes her with a genuine, sincere, warm smile. It's not a fake smile. This manager probably truly believes he's helping. It presents options. Certificates of deposit paying maybe 4.2% a year, mutual funds with management fees of 1.2% per year, structured products with elaborate names that sound sophisticated. The person leaves satisfied. You feel like you did the right thing. Now, here's the paradox that James Simons would have identified immediately if he were watching this scene with his mathematician's eyes. this person has just made one of the most costly financial decisions of his life. Not because the options the bank offered are necessarily bad in themselves, but because he made that decision without understanding the mathematically calculated opportunity cost of what he was doing. She didn't compare. She didn't calculate. She went to the only place she knew, accepted the options available there, and left without knowing that there was a whole universe of alternatives that the bank simply had no incentive to mention. According to data from the Federal Reserve Economic Data, FRED, the average interest rate paid for savings accounts at American commercial banks in periods of high interest rates is consistently between 0.3% and 4.5% per year, depending on the economic cycle. During periods of low interest rates, this rate often drops below 0.05%. That is, practically zero. Meanwhile, the United States' average annual inflation, as measured by the Bureau of Labor Statistics through the CPI index, has historically been about 3% per year for the past 5 decades. What does this mean mathematically? It means that keeping money in a traditional savings account during periods of low interest rates is equivalent, in terms of real purchasing power, to watching your money slowly shrink. Don't grow up. Shrink. And here is where $20,000 becomes the critical number. Because below $20,000, alternative options to traditional banking are genuinely limited. You can open accounts with high-yield fintechs, you can buy U.S. Treasury bonds in small amounts via treasurydirect.gov, you can invest in low-cost ETFs, but the full spectrum of tools that a mathematically informed investor can use starts to open up significantly once you cross the 20,000 mark. And it's exactly at this point that you start to have access to something that banks deeply fear: real choice with real power. Subscribe to this channel right now, because what I'm going to reveal over the next 35 minutes is the kind of mathematical analysis based on data from the Federal Reserve, the Bureau of Labor Statistics, and peer-reviewed research from the Journal of Finance that most people will never find anywhere, and that will permanently change the way you think about every dollar you have saved. Everything I share here is for educational purposes, based on verifiable historical data and documented mathematical principles. Nothing here is financial advice. But it's the kind of information that will make you ask much better questions of your financial advisor. And better questions always lead to better decisions. Now, let's get to the heart of the mystery. To fully understand it, we need to examine what James Simons identified as the biggest mistake in American financial education: the confusion between complexity and sophistication. The big banks and big asset managers build their business models around a belief they need you to maintain. The belief that managing money is intrinsically complex, that it requires highly trained and well-paid experts, that financial sophistication is available only to the very rich or the very financially educated. This belief is the foundation upon which management fee charges of 1%, 2%, sometimes 2.5% per year are justified. It is the foundation that justifies 20-page reports on investment funds that, when you read them with a mathematical eye, reveal that the fund simply replicates the market index, but charges for the privilege. Simons knew the difference between true complexity and theatrical complexity. In his quantitative laboratory in East Setauket, New York, he and his team of mathematicians, physicists, and cryptographers, people who had never worked in finance before, developed statistical models of genuine high sophistication. But the most powerful lesson to emerge from analyzing Simons's work is not be like Simons and create high-frequency trading algorithms. The most powerful lesson is much more accessible and much more disturbing to the financial establishment. In long-term efficient markets, simple math consistently trumps apparent sophistication. And that means that the person with $20,000 in a bank account, if equipped with the right knowledge, has access to tools that historically outperform most actively managed funds. Let me prove this with hard numbers, because that's exactly what Simons would do. Imagine two people. They both have $20,000. Both are 35 years old. They both want to make that money work for the next 30 years, until they are 65. The first person, let's call her Maria, goes to the bank and invests the $20,000 in an actively managed mutual fund that charges a management fee of 1.2% per year and has historically generated annual returns of 8%. The second person, let's call him Carlos, studies for 2 weeks, discover the principles that I will explain in this script, and invest the same $20,000 in a portfolio of low-cost ETFs, charging a management fee of 0.03% per year, with a historical return also of 8%. Because low-cost ETFs simply replicate market indices, after 30 years, Maria will have accumulated approximately $144,300. Carlos will have accumulated approximately $156,800. The difference? $12,500, more than 60% of the amount they both originally invested, simply evaporated in the form of management fees over 3 decades. And this in a scenario where the actively managed fund performed equally well as the index. In fact, according to research from S&P Dow Jones indices cited annually in the SPIVA scorecard, more than 92% of active American large-cap funds fail to outperform their benchmark over periods of 15 years or more. So Maria would probably end up with even less than the calculated $144,000. This is the first piece of the mystery revealed. Theatrical complexity has a real, measurable, devastating price in the long run. And the person with $20,000 who understands this mathematically is immediately dangerous to any institution that depends on them to continue paying for complexity that does not deliver corresponding value. But the mystery goes much deeper. To fully understand why $20,000 is the specific threshold number that transforms a passive bank customer into a potentially independent investor, we need to examine the structure of what economists call the accumulated opportunity cost, and how that cost operates invisibly and inexorably on the wealth of virtually every middle-class American family. John Kenneth Galbraith, the Harvard economist, who spent decades analyzing the behavior of American financial institutions, has a quote that has become famous in economic theory circles. The process by which banks create money is so simple that the mind rejects it. What he was describing was the credit creation mechanism, but the same logic applies to the mechanism by which the banking system captures value from ordinary depositors. It's so simple that the mind rejects it. And because the mind rejects it, most people never stop to calculate exactly how much this mechanism costs in terms of wealth lost over a lifetime. According to data from the Federal Reserve Board of Governors, American commercial banks pay an average of 0.5% per year on their traditional savings accounts, while lending that same money in the form of personal loans at rates ranging between 8 and 24% per year, depending on the product. The difference, the spread, goes to the bank. The depositor finances the bank's business for practically nothing. And what makes this especially powerful for the bank is that the depositor often doesn't realize that they are financing the bank. He thinks he is safely keeping money. Now, what happens when a person accumulates $20,000? Why does this number specifically change the equation? Because $20,000 is the point where several genuinely superior alternatives to the traditional bank deposit become accessible and practical simultaneously, creating a threshold effect, a quantum leap in the financial capacity available to the average individual. Let's examine what opens up mathematically from $20,000. First, short-term U.S. Treasury bonds, so-called T-bills, available in $1,000 multiples via treasurydirect.gov, have historically paid rates significantly higher than the average bank savings account during periods of rising interest rates. The difference between 0.5% per year and 4.5% per year on $20,000 is $800 per year. Money that simply disappears when you keep capital in a traditional retail bank. Second, access to low-cost index ETFs through commission-free brokerage platforms like Fidelity, Vanguard, or Schwab becomes more meaningful when you have enough capital to adequately diversify between asset classes. Third, the ability to contribute maximally to tax-advantaged savings vehicles like the traditional IRA or Roth IRA, $6,500 per person per year in 2024, becomes financially viable when you have $20,000 in emergency savings and still have capital left over to invest. Simons would immediately understand the mathematics of this. In the language of the quantitative theory he applied to high-frequency trading, what we are describing is a regime change, an inflection point at which the optimal behavior of the system qualitatively changes. Below 20,000, the optimal behavior is to accumulate emergency reserves in liquid and safe instruments. In 20,000 and above, optimal behavior shifts to a completely different allocation structure that incorporates multiple asset classes, tax advantages, and stratified time horizons. And the bank, the traditional retail bank, is structurally incapable of helping you make this transition, because the transition takes you out of the bank's business model. There is a second clue in this mystery that is even more disturbing than the first, and it has to do with something behavioral economists call choice architecture. How the options are presented to you determines, to a large extent, the choice you will make. This has been documented extensively by researchers such as Richard Thaler, winner of the Nobel Prize in Economics in 2017, whose work on behavioral economics has been published repeatedly in the Journal of Finance and by the National Bureau of Economic Research. When you walk into a bank branch with $20,000, the architecture of choice you encounter has been meticulously designed. Not out of malice, necessarily, out of economic incentive. The manager who makes you sign a mutual fund contract with a fee of 1.2% earns a bonus or commission. The bank earns guaranteed recurring income on its capital for the next year, 2 years, a decade. The agency continues to achieve its goal. Everyone within the system is incentivized to keep you within the system. But what if you walk into that same agency with real mathematical knowledge? What if you know that the average fee on low-cost index funds is 0.03%, 40 times lower than the fund they're offering you? What if you know that over 20 years, this rate difference will represent, on average, 32% of your final equity? What if you ask the simple and devastating question, what is the management fee for this fund, and what is the fee-adjusted historical performance compared to the S&P 500 index over the last 15 years? This question changes everything, not because she's aggressive, not because it's inappropriate, but because it demonstrates that you understand what is happening mathematically. And a person who understands what is happening mathematically cannot be guided solely by the choice architecture that has been carefully constructed around them. She starts making choices based on data, not perceptions. And this type of person is exactly what banks call, in their internal jargon, a low-profit customer. Vanguard, in its research paper published in 2019 under the title Putting a Value on Your Value, Quantifying Vanguard Advisors Alpha, estimated that structured financial knowledge, the kind of knowledge that leads a person to minimize fees, maximize tax-advantaged contributions, and maintain rational rather than emotionally reactive asset allocations, can add approximately 3% per year to the average investor's effective return. At $20,000, 3% a year is an additional $600 in the first year. But over 30 years, with the compounding effect, that 3% a year differential turns $20,000 into something radically different depending on which side of knowledge you are on. With an additional 3% per year for 30 years, $20,000 becomes approximately $321,000 instead of $146,000. The difference? $175,000, 8.5 times the original amount invested, created solely by knowledge, not by luck, not by connections, not by starting with more money. Now we come to the darkest core of this mystery. And this is where James Simons' story becomes not just inspiring, but functionally revealing of a mechanic that affects every American who has money saved in any form. There is a concept that Simons has applied obsessively throughout his career: the idea that the financial market is a signal generator with overlapping noise. There is signal, real information, genuine patterns, verifiable trends. And there is noise, random fluctuations, meaningless variations, oscillations that seem important but contain no real information about the future. Most market participants, according to Simons, spend most of their time reacting to noise as if it were a signal. They buy when the news is positive. They sell when the news is negative. They make portfolio decisions based on newspaper headlines, televised analyst opinions, and momentary market euphoria or panic. Simons did exactly the opposite. He created models that filtered out noise and responded only to signal. And the result was the most consistent performance in the history of American quantitative investing. But here's what's truly eye-opening for the person with $20,000. You don't need high-frequency algorithms to apply Simons' fundamental principle. The fundamental principle is simply this: separate signal from noise and respond only to the signal. For the long-term investor with $20,000, the signal is extraordinarily clear. The signal is the American stock market, as measured by the S&P 500 index, has returned approximately 10% per year on a nominal average, or about 7% per year adjusted for inflation, over the last 100 years, with data verifiable by Dimensional Fund Advisors research. The sign is lower management fees consistently produce higher net returns for the investor. The signal is regular automatic contributions to tax-advantaged vehicles produce mathematically superior results than ad hoc contributions based on when the market looks right. The noise is the market will fall because the Federal Reserve will raise interest rates. The noise is that technology company is going to triple in price next year. The noise is now it's time to sell everything and wait for a correction. The noise is that actively managed fund with incredible returns over the last 3 years will continue to perform the same over the next 10. Morningstar's research, published in its annual report Mind the Gap, has consistently demonstrated that the average return the individual investor actually captures is significantly lower than the return the fund they invest in actually generated, for one simple reason. Investors enter funds after periods of good performance and exit after periods of poor performance, exactly the opposite of what produces optimal returns. They respond to noise. And the traditional banking and financial system is perfectly designed to feed noise, because noise generates transactions, and transactions generate commissions. I want to pause for a fascinating social experiment. I'm going to ask you to write in the comments below the name of your city and state, along with a simple answer to this question. Have you ever made an important financial decision, buying, selling, moving money, based primarily on a news headline or something you saw on financial television? I'm genuinely curious to see if there is a geographic correlation in financial behavior based on noise versus signal. Some behavioral economics research from Harvard Business School suggests there may be. Let's test. Now, Let's examine the third layer of this mystery, because so far we've talked about what banks don't want you to know about fees and the distinction between signal and noise. But there is a third dimension to this story that is possibly the most powerful of all: the mechanics of time. James Simons, when analyzing the behavior of markets over decades of historical data, observed something he called the temporal persistence of fundamentals. What he meant was that while short-term prices were highly variable and difficult to predict reliably, long-term fundamentals, economic growth, workforce productivity, technological innovation, showed remarkable patterns of persistence. The short-term market was chaotic. The long-term market was much more predictable than most people believed. For the person with $20,000, the mechanics of time work in a way that can be calculated with extraordinary mathematical precision, and the results of these calculations are almost impossible to believe without seeing them. Let's do this calculation together, step by step, so that it is absolutely clear. Suppose you have $20,000 today and you are 30 years old. You invest that $20,000 in a portfolio of low-cost ETFs with a historical return of 10% per year and a management fee of 0.03% per year. You don't invest any additional pennies. Just let those $20,000 work for 35 years until you're 65. At the end of 35 years, those $20,000 will have turned into approximately $556,000. This is not typo. $556,000, starting from $20,000 without ever adding a penny, simply because time and compounding did their work. Now compare that to the cost of waiting just 5 more years before starting to invest. If instead of at 30, you start at 35, those same $20,000 will only be working for 30 years. And instead of $556,000, you will have to $149,000. The 5-year wait cost $207,000, 10 times the original amount invested. Albert Einstein, and there is historical evidence that he actually said something like this, documented in correspondence held at the Einstein Archives in Jerusalem, called compound interest the 8th wonder of the world. What he didn't say, but Simons would certainly understand, is that the complement of the 8th wonder is cumulative opportunity cost, which is the 9th wonder in reverse, the ability of time to silently destroy value when you're on the wrong side of compounding. According to data from the U.S. Securities and Exchange Commission, published in its investment guide for the general public, the difference between a portfolio that starts at age 25 and one that starts at age 35, holding all other variables constant, can result in a difference in wealth at retirement of 300 to 400%, not 30 to 40%. 300 to 400%. Most of any wealth built over a lifetime by the average investor doesn't come from particularly smart choices about which stocks to buy. It comes from when to start and how long to let the money work uninterruptedly. And this is precisely where the behavior that banks encourage, moving money frequently, responding to opportunities, redeeming investments in times of volatility to protect capital, is most destructive. Every time you interrupt the capitalization process, you pay a cost that does not appear on any bank statement, but that is completely mathematically calculable: the cost of lost time. Here's where the investigation takes a turn few people expect, because so far, we've talked about what the person with $20,000 can do differently. But we don't talk about why banks actively, not passively, actively have an interest in you not doing these things. To understand this, I need to explain how banks actually make money, because the answer is very different from what most customers imagine. American retail banks operate a business model that has 3 main sources of revenue. The first is the interest spread, the difference between what they pay depositors and what they charge borrowers. The second is service fees, account maintenance fees, overdraft fees, transfer fees. The third, and for our purposes the most relevant, is income from investment products, commissions and distribution fees from mutual funds, insurance products with an investment component, and wealth management services. According to data from the Federal Deposit Insurance Corporation, the FDIC, which publishes detailed analyses of the profitability of the American banking sector, revenue from fee-based services represents a growing share of the profitability of large banks, especially since post-2008 regulatory reforms that have compressed margins in some areas of traditional business. What does this mean for you as a customer? It means that the bank has a very strong structural incentive to keep its money within the ecosystem of products that the bank distributes or manages. A customer who has $20,000 in a savings account generating 0.5% per year is, from the bank's point of view, a customer who has not yet been completely monetized. But a customer who has that same $20,000 in a mutual fund at 1.2% per year, which the bank distributes and receives a distribution commission, is a significantly more profitable customer, without the customer necessarily realizing that the product he chose was presented within an architecture that made that choice the most likely. Morningstar published in its 2022 report on the U.S. fund industry that the return difference between low-cost index funds and the average actively managed fund, adjusted for fees, was approximately 1.6% per year over the past decade for U.S. large-cap funds. It may seem small, but at $20,000 over 30 years, 1.6% point per year, more compounding results in approximately $93,000 additional dollars of equity. $93,000 that the person who invests in high-cost funds simply never sees, which disappear silently. A fraction of a percentage point per year, invisible in everyday life, but devastating in their accumulation. There is a fourth level to this mystery, and it's the level that ties it all together, where the mathematics of James Simons, the structure of banks, the behavior of the average investor, and the specific power of $20,000 meet in a single unified insight. Simons, in one of the rare interviews he gave throughout his life, he was famous for being extremely secretive about his methodologies, said something that stuck in the memory of everyone present. The market rewards those who have systems, not those who have opinions. Scythe. It was a statement of mathematical principle, but it was also a veiled critique of the prevailing Wall Street style of investing. The approach based on fundamental analysis, compelling storytelling about why a particular company will grow, and personal conviction about the direction of the market. Systems versus opinions. This is the core of the difference. And for the person with $20,000, building a system doesn't require supercomputers. It doesn't require teams of mathematicians. It doesn't require access to high-frequency data. It requires just 4 fundamental decisions, made once based on data, and then maintained automatically for decades. The first decision is asset allocation. What percentage of the portfolio goes to stocks? What percentage goes to fixed income securities? What percentage stays in short-term liquid instruments? According to research from Dimensional Fund Advisors Research, approximately 92% of the variation in long-term portfolio returns is explained by the asset allocation decision, not by individual stock selection, not by market timing, not by any other variable. 92%. The most important decision an investor makes is establishing an asset allocation based on their time horizon and volatility tolerance. And the vast majority of investors never do this analysis in a structured way. The second decision is instrument selection. Once the allocation has been defined, use the lowest cost instruments available to implement it. For the vast majority of investors with $20,000, this means low-cost index ETFs or index funds from Vanguard, Fidelity, or Schwab, with management fees below 0.1% per year. The third decision is automation. Setting up regular automatic contributions, ideally monthly, so that the system works regardless of the investor's emotions at any particular moment. This automatically applies the principle of dollar cost averaging, which, according to Vanguard research analyses published in 2021, results in slightly lower returns than immediate investment in consistently rising markets, but which has an immeasurable behavioral benefit. It removes the need for the investor to time the market, avoiding the most costly mistake most investors make. The fourth decision is rebalancing, determining in advance when and how to restore the original allocation when market movements throw it out of balance. If you decided to keep 60% in stocks and 40% in bonds, and after a year of strong stock market performance your allocation is now 75% stocks and 25% bonds, the predetermined system automatically tells you what to do: sell a portion of the stocks and buy more bonds to get back to the original allocation. This eliminates the need for human judgment in moments of euphoria or panic, the two times when human judgment is most reliably failed, according to decades of behavioral finance research from the National Bureau of Economic Research. 4 decisions, taken once, based on data and time horizon, and then maintained automatically. And that, it is the system that Simons, if he had to communicate his philosophy to the average American investor with $20,000, would have described. Not medallion funds' sophisticated trading algorithm. The underlying fundamental principle: systems beat opinions. Every time. In the long run. Let us now examine 3 concrete cases that illustrate how this principle manifests itself in the real lives of 3 people who represent common types of American investors. I am using these as composite illustrations based on research-documented patterns of behavior. They are not actual identifiable individuals. The first case, a 38-year-old public school teacher in Nashville, Tennessee, who had saved $22,000 over 7 years of strict budgetary discipline. She had this money split between a checking account paying 0 and a high-yield savings account at a national bank paying 3.4% per year. She didn't invest in the stock market because she was afraid of losing everything. A perfectly understandable emotional response, but one that, according to analysis of Federal Reserve data on long-term financial behavior, represents the type of risk response that most harms wealth building in the world. Long-term. When she learned to calculate mathematically what her real fear of risk should be, not the short-term volatility of the market, but the long-term risk of not having enough capital for retirement, she made a different decision. She allocated $12,000 in a portfolio of low-cost ETFs with a 27-year horizon until retirement, kept $6,000 as an emergency fund in a high-yield account, and used $4,000 to maximize her IRA contribution. In 27 years, with just that initial $12,000 growing at a historical rate of return of 7% per year, adjusted for inflation, she will have approximately $64,000 in real purchasing power, more than 5 times the initial value, without ever adding another penny. The second case, a software engineer in Seattle, Washington, 42 years old, with $28,000 in a savings account at a large national bank. He was financially sophisticated enough to understand the difference between stocks and bonds, but he made the most common mistake among smart people in finance. He tried to beat the market by selecting individual stocks based on his analysis of the technology industry, an area in which he was genuinely an expert. The result, over 4 years of active trading, had been a return of 4% per year. Excellent compared to savings, but substantially less than the 12% return that the Nasdaq index had generated over the same period. He was losing compared to simply buying the index and doing nothing, spending dozens of hours a month on analysis that actually destroyed value. When he applied Simon's principle of systems versus opinions, Recognizing that even with genuine expertise in the technology sector, individual stock selection tends to be a negative expected value activity for most individual investors, he radically simplified it. Low-cost technology index for the exposure I wanted, complemented by a broad index portfolio. The expected mathematical result, superior returns simply by eliminating the friction of your own active decisions. The third case, a doctor in Miami, Florida, 50 years old, with $140,000 invested in actively managed mutual funds within the 401k plan of the hospital where she worked. She had never reviewed the plan's investment options since she had set it up 10 years earlier, when the HR manager enrolled her in the standard options. Standard options had average management fees of 1.1% per year. Alternative options available under the same plan, which she didn't know existed because she had to go to a different section of the plan portal to see them, included index ETFs with 0.04% fees. The difference of 1.06% per year in $140,000 over the 15 years, until your retirement equates to approximately $32,000 difference in final wealth. $32,000 silently extracted by the inertia of the standard she selected once 10 years ago, without ever being questioned again. This is the system, revealed in its entirety. Inertia works for those who designed the patterns, and those who design the standards are the institutions with a financial interest in the result. We now have all the pieces of the mystery in front of us. Let's bring them together into a single framework that James Simons, with his mathematical mind and his obsession with hidden patterns, would immediately recognize as the central pattern of the relationship between the average American investor and the financial system that is supposed to serve him. The pattern works like this. The traditional banking and financial system is optimized to maximize value extraction from the average investor's capital through three simultaneous mechanisms: fees that are visible but underestimated in their long-term impact, choice architecture that steers toward higher margin products for the distributor, and engagement with the short-term noise of the market that generates transactions and, consequently, commission income. Resistance to this system requires neither hostility nor extraordinary sophistication. It simply requires what James Simons would call minimal statistical financial literacy, the ability to understand four fundamental concepts and apply them systematically. First concept: the compounding effect of rates over time is mathematically devastating and should be the first filter applied to any financial product. A difference of 1 rate point per year seems trivial. In 30 years, on capital of $20,000, it is the difference between $80,000 and $110,000. Every financial product decision should start with the question, what is the total rate and how does it impact my return in 30 years? Second concept: